Hello, and thank you for joining us today. I'm Chris O'Brien, a technology journalist based here in Paris, and we're having a conversation with Raphaëlle D'Ornano, CEO and founder of D'Ornano & Co., an advisory firm that looks at global deals involving disruptive technologies and companies that are pioneering new business models. D'Ornano has developed a pioneering diligence process for assessing these companies called Advanced Growth Intelligence, or AGI. We're here today to discuss Raphaëlle's new ebook, the GenAI Investors Playbook. The book brings together a lot of lessons your firm has learned over the past 2 years as you assess the impact of GenAI. So thank you for being here and looking forward to chatting more.
Thank you for having me. It's a pleasure.
Just for context, let's start with AGI. What is new about it? What is distinct? And why is it different from sort of classic due diligence?
Sure. Well, Chris, since I started the firm almost 10 years ago in 2015, and we've completed to date over 600 deals in the field of disruptive technology, most of these companies being high growth companies, which we define to be 15% or more organic growth. And after having completed these hundreds of diligences, it became clear to us that disruptive technology companies have their own patterns of growth, and that their value lies on their ability to grow durably and for a long time. And so what we've done basically is to develop a methodology which helps assess the prospects of long-term growth, long-term durable growth. And our process is based on 4 core blocks of analysis which revolve around quality of revenue, quality of growth, quality of margins, and balance sheet strength. And once we have completed this assessment in a steady state mode, we look to challenge the resilience of these companies to what we call single points of failure, meaning external shocks like GenAI that could potentially completely disrupt the model and make the company fall apart. So we've built this methodology across the whole disruptive technology tech stack with different business models, different sub-business models, and the methodology that we have allows to bring really a conviction on one, what is the right value, and second, what is the resilience of that specific business model. So this is what AGI is about.
Now, we're in a moment where GenAI has received tremendous hype. It also still faces a fair bit of skepticism. So what is your view on that? Is it being overhyped? Is it being underhyped? And do you see it having a long-term profound impact?
Sure. Well, I think that we have this immense opportunity of living through this new technology, which is a new technology, and which in my mind is as disruptive, or perhaps more, as the internet was back in 2000. So this is really a technology that, like, we have known others in the past, but this is the new technology of this current period. And what is very interesting about GenAI, first, is that it's not new. I mean, the development of ChatGPT, the launch of ChatGPT 3.5 in November 22 really accelerated this trend with a pace that has never been seen before, because if you look at the total revenue made by GenAI companies during the first year, this is so much more important than the SaaS wave, for example. But I think what is also very interesting about GenAI is that the profound implications of the technology go much beyond the technology itself. It affects SaaS companies, the technology field as a whole, and basically all the traditional economy, the traditional material world economy, with implications that are everywhere. And I find that to be fascinating.
Now, GenAI is a very complex topic. There are lots of issues to discuss around this. Your ebook, the GenAI Investors Playbook that just came out, is, as its name suggests, focused on how investors should approach this topic. So just on a high level, what are some of the big challenges investors face in understanding and analyzing this huge phenomenon?
So, like any new technology, everything at first seems to be like, oh, there are no rules because this is new, and so since this is new, there are no rules. But of course, this is not the case. Within our disruptive technology matrix that we have developed, GenAI is in a specific line where we put the different business models in GenAI that we might talk about just after, and these companies and these business models have their own rules. So like any other business model within the disruptive technology matrix, SaaS, science-based models, fintech, GenAI has its rules. And I think what is critical today for investors, and this is where we are right now, it's to understand what are the economics of these business models and to what extent do they really work. I had a recent discussion with an investor where I got pretty mad actually, where he was telling me, oh, the valuation of OpenAI makes no sense. And we started going into the discussion and looking at, well, look, this is the recurring revenue of OpenAI, which is growing very fast, and that is, north of $2 billion right now. And when you actually compare the valuation with its ARR, without making any crazy adjustments, by the way, it's actually pretty rational. Now, what is not rational is the valuation of many other of these companies within this tech stack, which are receiving multiples that are completely discorrelated to the revenue. And of course, I'm not talking about the profitability because this is not the subject yet. It will be in many months or years, I don't know. But right now, it's of course, as in every new technology, the prospects of long-term revenue that are of first importance. And so there is a lot of hype, but to go through the hype and to really do the right cherry picking, which is what investors should be doing, you need to understand the economics. I'm not here to help on, I understand the technology, but we're not here to say, oh, the tech is good or the tech is bad. And I probably would not know that like someone who has a PhD in GenAI. However, I'm here to say the economics make sense or make absolutely no sense. And you can read and measure all of this.
Now, you just referenced the GenAI stack. This is something you've also written about as kind of providing an overview to investors to help them understand, because like you, they're probably not necessarily deep tech experts in writing algorithms. So can you just sort of outline the three main parts of the stack that you've defined and tell us a little bit about how investors should look at each of those?
Sure. Well, I think if you take again the disruptive technology matrix that we have built, this is how we see the GenAI tech stack. We see 4 categories, which are as follows. The first one is really at the heart of the technology. It's the foundational models. So open source, closed source, the models that are enabling the technology to work. And to date, this is where over 60% of funding has gone, with a huge participation from corporate venture capital, because of course this is defining the cloud wars in the next months and the next year. So the war, the competition, to say it in a positive way, on LLMs today is absolutely critical, and it will continue. This is where the core of the money is going right now. Now, if you move up the tech stack, you have in the middle what I call MLOps, which is all the applications that enable companies to actually have GenAI as their core application. So it's, to put it in a very simple way, the tools around the models that enable effective GenAI implementation. And then at the top of the layer, you have the application layer that we decompose between vertical applications that are industry specific or horizontal applications that serve, like in SaaS, multiple industries. This is the core development that is set to happen, I think, starting now and in 2025. It's really going to be about the applications resulting from GenAI. Not saying that the model competition is over. This, of course, is going to continue, and it's very interesting, actually. MLOps is going to develop in a big way also, but applications is where, in my view, there's going to be the most interesting debate to see which ones stand out from the crowd and which ones do not. And of course, the fourth category I was referring to is consumer tech, which is the applications that are not B2B, like the horizontal or vertical that I just mentioned, but the ones that are for consumers. So still at the application layer, but consumer facing. So this is how I would categorize the tech stack: models, MLOps, applications.
Now, if I take each of those and look at them through the lens of a VC or PE firm, are there ones that are better suited to those different types of investments and ones that just make no sense for them to be looking at this point?
Well, maybe let's take the perspective of a private equity investor. A private equity investor is going to look, by definition, for predictable, stable cash flows. And so investing in models is not where private equity would fall right now, and this is perfectly normal because models are huge buckets of spend today where you're spending, you're having huge CapEx spend to actually build the model, get the GPUs, and it's cost, and it's normal because again, I don't know if it's going to be a winner takes all, and I think most people do not know actually, but this is spending a lot of resources, and this is not where private equity is investing its dollars right now. Private equity has a very interesting shot at looking at the applications part, either at new GenAI native applications or at SaaS companies who are incorporating GenAI within their products or creating new GenAI features. And this is where private equity today is spending a lot of time. MLOps, we think there's going to be a strong wave of consolidation here. There are many companies in this field. You have companies like Databricks that is really taking the lead and showing how it's able to convert itself into a key MLOps player by multiplying famous acquisitions. Companies in the field are following, and so I would see MLOps as a field for intense M&A in the months to come, years to come. I would see applications as a fabulous playground for private equity investors with, again, a right understanding of these economics, and models still VCs, asset managers, and corporate venture capital. This is how I see where everyone is investing right now.
Now, you made a reference earlier to open versus closed foundation models, and you said that that's not necessarily where PE should be looking right now, but are there elements of that debate that they should be aware of and taking into account when they're thinking about investing in those other layers?
Well, I think a mistake that probably has been made is to understand where and what is the value of the technology that you are building. For example, the models are where there's the most value because that's by definition where you're concentrating all your R&D. When I say that, I mean you're concentrating the technology at the model space, and so most applications do not have the model and the application. They're calling the models through API calls, for example, and they're not possessing that actual technology, but just the application itself. And so what is interesting to understand is to be very clear on what do you have within the tech stack and what do you not have, first point. And I think on that point, it's really a question about not just open or closed source, but I would more say the size of the model. Do you really need a large language model, or are you better off with a smaller language model like the ones that Mistral are developing, which are very efficient? And why do I think that is more the key debate than open versus closed for an application? Because it's completely changing the game in terms of inference costs, which are the biggest costs in terms of gross margin impact. And if you make the wrong choice from a model perspective and you have a large language model versus a small one that could have done the job in a better and in a better way from a cost perspective and more efficient from a technical perspective, you need to make that choice. And this is where we're seeing a lot of questions that are having both CEOs and private equity investors, and this is the question that is still being sorted to date.
Yeah.
And I would also add, if I may, that within this, the separation that could have seemed obvious between closed and open, you're seeing that a lot of the open model companies are developing closed source models that they are selling versus the ones that are being provided through open source. And you're seeing the price of ChatGPT that is going drastically down, and many are thinking that there's going to be commoditization around this. So I think this is a debate that is still completely open, and that the frontier is not black and white, and it's at best gray, I would say.
Well, now one of the things you do in the book is do a breakdown of Mistral AI's business using the AGI framework to understand that. So what kind of insights did you gain for Mistral AI's open business approach?
Well, I think Mistral is a very interesting case. Look, Mistral, these guys, they have a fabulous technology. They have one of the best teams, if not the best team in the world. From the model perspective, these guys are great, like from, again, a technical standpoint. I think everyone was saying, oh, this French company has no chance. They're going to be competing against the big OpenAIs, like against big US actors. And I mean, I think they're on an interesting path, and they're showing that this war or competition is still wide open. I think what Mistral, what is interesting about Mistral is that they're taking this from a customer segment approach and saying what we are addressing are enterprise customers with very specific needs where the privacy of the data and the security of the data is what is mission critical. And the models that they are deploying are allowing large enterprises to deploy GenAI in a secure and efficient way. So taking that, where they monetize and what they're expecting to monetize is on top of the model itself, is on services revenue, where of course there's going to be a lot of integration, a lot of services to be done with these clients. And so they're thinking about their revenue model in a way that is not just what is like the price of my tokens, which is how open source models work, and not like what is the cost of my models that I could commercialize if they were selling larger models, which is not their core focus yet, but they're taking their small open source models and saying, well, we can monetize beyond the model itself, and we can actually provide true service. That's probably an interesting path forward for this company and for others that are playing in the field.
Now, if coming back to a PE investor, I'm looking at all this, I'm wondering where to start. What are some of the big questions I need to be asking? What are some of the categories of ideas that I really need to examine as I'm trying to understand this whole phenomenon?
Well, I mean, I think private equity investors, to put it short, they can ask three questions. The first question that, and private equity investors are, of course, already asking these questions is, how does GenAI impact my productivity gains? Take any portfolio company, and how does GenAI change the structure of my R&D, my GenA, and my sales and marketing, which, to simplify, are the three core buckets of OpEx. And GenAI should be impacting all three of these buckets in proportions that are, of course, different according to the business model that we're talking about. But that's, I would say, the most obvious and immediate task that should be completed. But it already should be finished or well completed right to date. The second is more difficult, is how can GenAI change my revenue and, as a following step, my gross margin? And what I mean by that, it's how do I capture the benefit of transforming my product or incorporating new features in my product? This is true for SaaS companies, but this is true for any other material world companies. How do I make my product better? And how do I extract more value from the product that I'm selling? So in the SaaS world, for example, it's how am I going from a user-based pricing to a usage-based pricing with all the reflections that follow that change from user-based to usage-based. And it's really about how do I capture the cost that I have developed upfront in a value. And it's a challenging question. And then the third aspect, which is perhaps the most difficult of the three, is to what extent is GenAI, again, the single point of failure? To what extent can GenAI basically kill my business model? And this is not going to be something marginal. I know it can seem scary, and I know it can seem very scary when, again, you're already in a world that is going very fast, uncertain, with so many other risks, geopolitical, macro, etc. But the risk that GenAI can kill your business model is not like this faraway risk. And this killing can take two forms. The first form is it can kill you financially, meaning that your competitors will have incorporated those productivity gains, number one, and will have incorporated that revenue model transformation, number two. And so your competitors will have a margin structure that makes them compete in a much more efficient way versus you. So that's how you die in form one. In form two, it's your product is completely replaced by something from the GenAI world. Think, for example, answer engines versus search engines. Well, to see how that is going to develop can have consequences that are so fundamental. It's not a question about having the right margin structure. It's a question about your business model could not exist. And so thank goodness, like in any revolution of this kind, there is time to adapt, but it's extremely important to have this prospective thinking and to know that the challenge is not in 1 year or in 2 years, but it's at your door. And I think this is where I'm seeing maybe I don't know, people who are scared, people who are questioning. It's the degree of urgency is what should be the number one priority for any investor today.
Now let's come back specifically to SaaS, which you just mentioned. You end the book with a very provocative analysis of the impact that you believe GenAI will have on SaaS. And this seems to really highlight, again, your view of just how important this trend is going to be. You argue that the rule of 40 that has sort of governed SaaS investments the past decade or so is going to become the rule of 55. So talk a little bit more about what you see, some of the metrics that are driving that, and how investors need to really understand the impact of that in the SaaS market.
So indeed, we suggested that we were going to go from a rule of 40 to rule of 55. I think a first point is to say that in this current landscape, rule of 40 is already a very high bar, and most companies are actually well below the rule of 40 because growth is hard to come by, but let's put that aside 1 minute. If you go back to rule of 40 being the normal and how do you go to rule of 55, well, taking what I have just said on how GenAI is impacting private equity in general, I think that first you're going to have huge productivity gains at SaaS companies, and that these productivity gains could result anywhere between 12 and 13% of OPEX gains. I'm really talking about OPEX because in those 12 to 13%, I'm not incorporating gross margin. I'm really below gross margin. And I think that when you take the category of sales and marketing, this is where there's going to be an impact perhaps up to 5% or even north of 5% if you take the gains that you're going to be able to make on content marketing, on pre-sales optimization. So on this whole part that is the bulk of SaaS costs today, this is where we see outsized impact. We see outsized impact on R&D for new code and for existing code, which I think is something new that investors are really starting to understand. It's GenAI does not only help you write new code more efficiently, it can help you write according to the complexity of the existing code, but existing code in a very efficient way. So within that R&D part, you can have easily 5 points of gains. It depends, of course, on the P&L structure, but you have 5 and 5, so that's 10 already. Now, between 2 and 3 on G&A by very easily incorporating GenAI tools within your accounting, HR, legal, finance departments, and you don't need to do anything. You just need to have the right tools, and you can go and get those 2 to 3% gains plus productivity gains on your existing workforce. And that leaves you between 2 and 3 points to reach the rule to go from 40 to 55, right? And I think this is where it's going to be more at the gross margin level. So I expect that there's going to be perhaps 2 points of additional growth for the companies that are going to be able to embrace GenAI, either new features or new products. And on the gross margin itself, once the companies have managed to pass on inference costs and saying that inference costs are not something that is actually going to lower your gross margin, I think you can make gains from a professional services standpoint on customer success, and that would leave you with a 1% gain. So that's how you go from 10 plus 2, 12 plus 2 plus 1, that's how I reached the 15.
Oh. Well, to wrap this up, this has obviously become a core part of what you're doing here at D'Ornano & Co. Do you have any final thoughts about just to investors about what they should be thinking, how serious they should be taking this, or how they should be viewing this moment in time, which is often complex and exciting and terrifying when there's huge disruptions in the market?
Again, this is a very exciting moment with its challenges, of course, and the best way to manage this new technology, like we have managed other new technologies, and the internet was again another example of that, is to take a very rational approach by looking at the economics and looking at how do I measure this GenAI transformation. Either how do I measure like a new native GenAI company model, MLOps, application, and what should I be looking at in my P&L, in my growth trends. And then if you're an existing company incorporating GenAI and putting GenAI front and center of your business model, how do you read that transformation? How do you read that transformation from a revenue perspective, from a growth perspective, from a margin perspective? And that will allow investors to separate companies that are just saying they're doing GenAI but that have not changed at all their P&L structure and then they're not doing GenAI versus companies that are actually leading the way to this transformation. And there are going to be the rules are going to change, and companies that are not able to seize this opportunity. Again, I always prefer to be optimistic than pessimistic. This is an opportunity if you respect several criteria, if you look at this in a rational way, not about the technology, but again, the economics, and you can approach this from a rational way, if you move fast, and if you develop prospective thinking. This would be my ultimate recommendation, is no one knows. So when no one knows, you measure, you look at concrete things, you try to assess what could happen, and that's how you anticipate any disruption. And that would be my only recommendation, which I hope will help everyone.
Yeah, and certainly you've set out a framework, and with the publication of the GenAI Investors Playbook, you've given them a place to start really to do that very thing, to understand this moment in time. Well, I want to thank you for your time, and congratulations again on the publication of the book. It's certainly very timely, very instructive, and I think it's going to be a great tool for investors, particularly PE investors, trying to understand this moment. It's now available online, I believe, to download. So congratulations, and we look forward to having more conversations about GenAI.
Thank you, Chris. Thank you for this interview. It was great. Thank you.